The worst should have been behind us by now, but interest rates are continuing on their seemingly endless upward march.
Catastrophe, a potential homeowner time bomb.
And they could go even higher.
It's going to get worse. And that's just not my words, friends. Yesterday we saw a further interest rate rise that, although was titled a shock in many headlines, was something I saw coming a long time ago. And I'm sure many of you did too. But this little snippet is worth listening to before we jump into some of the most important news that you need to hear this month.
What this means for households, how will this feel for many people around the country?
Well, I understand the difficulty and the pain it causes for many people, and I do understand that. What I would say, though, is that if we don't get inflation back down to target, then it goes on for much longer, and the pain goes on for longer.
You've said that you'll do anything it takes to try to bring inflation down. Does that include potentially precipitating a recession?
So we're not expecting, we're not desiring a recession, but we will do what is necessary to bring inflation down to target.
And will you apologise for the fact that the bank has continually failed to forecast these sharp rises in inflation? Something clearly went wrong in your forecasting.
Forecasting has been very difficult in an era with such big things going on around us. There's a war, obviously we've had the pandemic. We need to understand how we can best respond to those sorts of shocks. In terms of tackling inflation, we've now raised interest rates by nearly 5% in 18 months. So we've taken decisive action.
The markets right now think that there will be more rate hikes to come.
Well, we will respond to the evidence as we see it. That's important. So we've been very clear today. We're not signalling what's going to come next because we'll respond to the evidence, but it was absolutely imperative in my view that we took this action today.
It's fair to say that the UK is something of an outlier. We have the highest inflation in the G7, interest rates going up faster here than, for instance, in the US or in the Eurozone now after today's decision. Is the UK an outlier, and why?
I think when you look across many countries in the world, actually this pattern of persistent and rather sticky inflation, particularly sticky core inflation, actually that's the sort of the things once you take the more volatile things, like energy for instance. You see it across a lot of countries now.
Well, there you have it. Some insight into Andrew Bailey's thoughts around inflation and the fact that out of the G7 countries, the UK isn't looking too great. Now, as I'm not an economist myself, having only achieved a B in my A-levels, one of the issues with interest rates that I've not yet discussed on the channel is something Martin Lewis actually pointed out yesterday. The banks are not passing rates on to savers and merely only hitting borrowers. If interest rates were higher for savers, we could certainly incentivize people to attempt to save more at the very least to mitigate against the high inflation rates that we're seeing. But instead, it seems the rises are solely hitting those who borrow money. So first-time buyers, those looking to refinance properties, those seeking investment opportunities are now seeing rates making purchasing properties seem a lot less appealing. And usually a correction of some sort or a slowdown in house prices, which has been much faster than normal over the past few years, could be seen as a good thing. But the worry is that as normal people may struggle to get on the property ladder or seek out their first investment, those with big fat wallets and institutions will gladly pick up what's left and take over. And feeling a little cynical this morning as I'm recording this, it almost feels like some of this was by design. Push out the smaller middle person and start to take over. Now, it's important to obviously look at the house prices within the UK, and I found an interesting article that I thought I'd show you guys around where house prices were rising and falling the most. And the reason I think this is a useful share is because when talking about property prices, whether they're crashing or booming, one thing we have to be mindful of is that certain areas react differently to others. So if we just look at some of the areas, we have Kensington and Chelsea house prices falling by 15.8% in April, compared with 12 months earlier. Now, this is actually the largest year-on-year drop at any local authority in the country. And reports showed that house prices in the London borough had fallen by 9.3% in March, 4.2% in February, and 2.3% in January, suggesting that things look like they're getting worse. Now, Westminster had the next largest drop at 13.3%, followed by the City of Aberdeen at 7%. But in total, 27 local authorities experienced a fall in average house prices. However, my friends, it's not all doom and gloom. East Lothian is a property hotspot at the moment. House prices in the local authority just east of Edinburgh rose 17.2% in April, which is up from 9% in March and 5% in February, showing a completely different trajectory to the London boroughs. And then we have Fide in Lancashire, apologies if I pronounced that wrong, showing the next largest increase at 15.5%. And just in case some of you are interested, we have Melton showing a 13.3% increase, Swindon 12.4%, Inverclyde 12%, and West Devon at 11.7%. So it's certainly interesting to see how the markets are playing out across the UK. Now, what I will do is leave this link in the description so you can play around with the image yourself. And off the back of that, this segues us nicely towards rental figures, which seem to be outpacing earnings for 21 months in a row. The average UK rent now hits £1,126 a month, with rents in London at around £2,000 on average. Now, this rental increase by more than 10% is the 15th monthly increase in a row, with UK renters seeing an increase of around £110 a month since April 2022. Now, there is some good news, at least in comparison to the figures, and that's that rents for the new lets have started to slow down, reflecting seasonable trends. In the past 3 months, the average rent increase has only been 0.6%, which is actually the smallest amount since May 2021. And for anyone in Northern Ireland, you have the lowest rental inflation at 3.7%, which is an increase of £30 per calendar month since April 2022. And if you're interested, here's a chart showing the percentage changes in rents and the average rent you could be expected to pay depending on the region. Next up, friends, it's important to reiterate something I mentioned a year or so ago on this channel, and I've warned a few times recently as well. The mortgage crisis that will affect more than 1 million people in the UK. 1.4 million UK mortgage holders will face 20% hits on their disposable income due to the mortgage costs increasing. And we've seen this off the back of a sharp increase in the cost of high street bank loans, which are now above 6% as of recording this video. And for those in London, it doesn't look any better, with payments rising by about 12% of disposable income. So the tagline I've been sharing for almost a year now, which is more pain ahead, will be finally rearing its ugly head. So what does all this mean, my friends, at least for the property market? Are we going to see a crash or not? Well, with opinions split, with some adamant it will never go down and others predicting as high as 30% plus, let's visit some industry experts and see what they have to say. We have Nikki Stevenson, Managing Director at Fine & Country, stating, "The housing market has been incredibly resilient, but mortgage rate pressures are putting a damper on price growth. Despite this, the market remains strong, with buyers benefiting from rising stock levels and incentivized by the prospect of negotiating a good deal on their next home." Agreed sales at the end of May reached their highest level of the year so far, up 11% on a 5-year average on the same period. However, there are some potentially darker clouds on the horizon, as mortgage products are being pulled and the bank and borrowers are on tenterhooks awaiting the Bank of England base rate decision this week, which of course we know was obviously up by 0.5% as we shared at the beginning of the video. People have got used to higher interest rate environments, but we could see further downward pressure placed on houses if 6% fixed rates remain the norm. Now, Ian McKenzie, CEO of the Guild of Property Professionals, states, "In spite of the financial challenges facing many households across the UK, the housing market is still holding up strongly. A £7,000 fall in the average value of a house in September may worry some homeowners, but prices are still far and above pre-pandemic levels. There will always be a demand for quality housing, and that will keep prices buoyant and help guide the property industry through the storm. Sellers need to feel reassured that their house is not losing any significant value, and buyers need stability in prices so that they can properly gauge how much it will cost them to get on the ladder. Affordability, however, is the biggest concern for buyers at the moment, as surging mortgage rates play on people's minds. Nobody wants to sign up for a mortgage and face the uncertainty of whether they can afford the repayments. As inflation will hopefully ease off in the second half of the year, and so too will interest rates, we should see confidence return to the market, as well as the availability of competitive mortgages. Now, if you're considering selling your home," and then he goes on to obviously try and sell services, so obviously just be mindful of what this person's motives are. Not saying that he's incorrect in what he's saying, but it's always important to have that at the back of your mind. And then finally, my friends, we have a mortgage expert warning that the housing market crash now looks inevitable. James Elvin, director at Strive Mortgages, stated, "The challenge of tackling inflation has been massively underestimated by the government. Now it is over to the Bank of England to react, which will almost certainly pile further misery on borrowers as rates go up again. It's the perfect storm right now, and the future feels bleak." And I'm sharing his sentiments now with what he states. "Expect the base rate to rise to 5.5 or 5.75% by the end of the year. It's a ticking time bomb, as 1.4 million borrowers will see the end of their low fixed rates end this year, and the impact will be beyond words. I fear for the property market, and a crash seems inevitable at this point."